Hi friends, welcome to the channel JIB and CIB Made Simple. In this particular video, we are going to discuss AML KYC memory based question along with explanation for the exam date 8th November 2025. So these questions, there are almost 20 to 30 questions which I have collected from students who have given examination, appeared in the examination, and this question will help you see what is the level of examination, what are the important topics from where question are being asked, so that you can prepare accordingly, right? So let's start with the first question. First question is, which of the following statement correctly describe the concept of back-to-back loan in the context of money laundering? The very important concept here is back-to-back loan. Please mark it down, very important. So the options are, it involves two parties exchanging loan in different currency without any collateral. Option B, a money launderer transfer illicit fund to another country as a security for a bank loan, which is then sent back to the original country. Option C, it refers to borrowing funds from multiple banks simultaneously to hide the source of money. Option D, it is a method where criminal proceeds are directly deposited into offshore account without any formal agreement. So these are the options that have been given. Now, which statement correctly describes the back-to-back loan? So option number A, if you look at the option number A, it says that, that two parties exchange loan in different currency without collateral. So two parties are there, right? They exchange loan. Two parties are there, they exchange loan in different currency and no collateral is there, right? It sounds fancy, right? But this is just a currency swap, not money laundering. So this is just a kind of, currency swap, not money laundering. Because if we talk about the back-to-back loan, it involves using illegal money as a security for the loan, right? So that's the point. So not just exchanging currency. Here we are talking about only exchanging currency. That is currency swap. This is not the correct answer. Option number B, yes, this is the real deal. What happened? So friends, option number B, this is the real deal. Suppose a launderer send dirty money to another country. So let me give you one example to understand it. So suppose this is a launderer. What he does, he send dirty money. Where? To another country. Right. He send dirty money to another country. Why? So basically as a collateral, right? And uses the dirty money as a collateral, right? To give a loan in the original country. So now the money looks clean because it came from a bank loan. So imagine, let me give you one example. Imagine you have 10 crore of illegal money, right? So you send it to a foreign bank as security. This 10 crore you have sent to the foreign bank as security, right? So that bank help you get a 10 crore loan in India. Now your money look legal because it came from a bank loan, right? So this is the example of, yes, that is what option number B is correct. What about C? It refers to borrowing funds from multiple banks simultaneously. See, borrowing from multiple banks at the same time, this is called, loan layering. So suppose the question asks about loan layering, then this would be the correct answer. That is called, loan layering, right? But not back-to-back loan. It is another trick, but this is not the correct one. What about D? D says it is a method where criminal proceeds are directly deposited into offshore account without any formal agreement. So, directly putting money in offshore account without agreement, that is just hiding money abroad. So this is just, Now, if you look at the option number D, it says that directly putting money in offshore account without agreement, right? That is what it is all about. So that is just hiding money abroad. It is called, hiding money abroad, right? So, back-to-back loan requires a structured loan arrangement. If you talk about the back-to-back loan, it requires a structured loan arrangement to make the money look legitimate, right? So that is the point. So option number D, if we talk about, so back-to-back loan requires a structured loan arrangement to make the money look legitimate. That's why option number D is also wrong. So what is the correct answer? Correct answer is option number B. So whenever you hear this word back-to-back loan, just think about it. We have dirty money, right? And that dirty money, I have of it like this. You have a dirty money and you have sent that dirty money into the foreign country and you are using that particular money as a collateral for the loan, right? So now that dirty money looks legal, right? It looks clean. So basically this is like, using illicit fund as security for the legitimate loan. So you can think of it like, loan against your own dirty money. Loan against your own dirty money abroad. Loan against your own dirty money abroad. About FATF. What is FATF? Financial Action Task Force, right? So which of the following statement about Financial Action Task Force membership as of 2025 is correct? So this is the recent data, right? This is the recent data. Option number A, FATF has 39 members. all of which are individual country. FATF include 39 member, 37 jurisdiction, 2 regional organization. Option C, FATF membership is limited to country in Europe and North America only. India is not a member of FATF as of 2025. So question is, which statement is correct? Right. So if you look at the option number A, so it says that 39 member and all are country. It sounds closing, but it is wrong, right? Because FATF has 39 member. FATF has 39 member, but 2 of them are regional organization. 2 are regional organization, right? Let me give you the name, like GCC, right, and European Commission. They are the regional organization. They are not the country. But what they are written? They are country. No, all are not country. Some are regional organization, like GCC and European Commission, right? They are not countries. They are regional organization. Second point. Option number B says FATF include 39 members, 37 jurisdiction and 2 regional organizations. Yes, this is correct. How many countries are there? 37 countries are there. 37 jurisdictions are there. 2 regional organizations are there. Right. What are the name of 2 regional organizations? Gulf Cooperation Council and European Commission. These are the 2 regional organizations. So some big names like USA, like India, China, UK, France, right? These are the big names. UK, USA, India, China, UK, France, Japan, all are the member. India joined in the year 2010. So option number B is the correct answer. What about C? FATF membership is limited to country in the Europe and North America only. This is incorrect. No way. FATF is global. Member include country from Asia, Middle East, Africa, Latin America. What about India not a member? No. India is also a member. India has been a full member since 2010. Right. So what we learned from this discussion is that sometimes question is asked regarding the number of members in FATF. Total 39 members are there. 37 country plus 2 regional organizations. 2 regional bodies are there. What are the name of regional body? GCC and European Commission. And you can think it like this. 37 plus 2 is equal to 39. And GCC and EC. GCC means Gulf Cooperation Council and ECM is European Commission. These are 2 extra. I hope that makes sense. Now friends, let's see the next question. Which of the following best describe the non-member of a institution to mitigate risk associated with trust? Very good question it is. Ignoring the identities of trustee and beneficiary. So basically the question is what why trusts are so much risky, right? What are the measures? What are the risks which are involved in trust and how to mitigate that? Option A, ignoring the identity of the trustee and beneficiary. Option B, enhance due diligence, including verify all parties and monitoring transactions, allowing trust to operate without documentation, prohibiting trust from holding asset in any jurisdiction. So which measure do you think is correct? So friends, option number A, if you look at, it says that ignoring identity of trustee and beneficiary. This is a big no. This is a big no. Why? Because if you ignore who is behind the trust, you open the door for money laundering, right? If you ignore who is behind the trust, you open the door for money laundering. So that's why it is wrong. What about option B? Option B say enhance due diligence, including verifying all parties and monitoring transaction. Yes, this is the correct one. Why? Because financial institutions apply enhanced due diligence. That is called EDD. So they identify the settler. Settler is the person who create the trust. Settler is the person who create the trust. Second thing, they identify the trustee. Trustee is someone who manages the trust. Right. They identify the beneficiary who benefit from the trust. So EDD, that is financial institution, they identify the settler, they identify the trustee, they also identify the beneficiary. Let me give you one example. For example, let's suppose a trust is there. Right. Suppose there is a trust and that particular trust suddenly move large sum to offshore account. This move large sum to where? To offshore account. Right. So the bank check if it is legal and report if it's required. Right. So if a trust suddenly move large sum to offshore account, the bank check if it is legal and report if it is required. Report also done if the report is required. Right. So that is the point. What about option C? Allowing trust to operate without documentation. So see, allowing trust to operate without documentation, that is like letting someone open a bank account without ID. That's quite impossible and it is very risky. So it is wrong. What about D? Prohibiting trust from holding asset in any jurisdiction. See, prohibiting trust from holding asset globally, that is unrealistic. Right. trust can hold asset worldwide, but under a strict compliance check. So what we learned from this discussion is that, trust are highly risk. Trust bear high risk, right? High risks are there in the trust, right? So bank do extra check. Bank required to do extra check. In what form? So you need to identify all the parties. When I say party, first thing is identification. Identify. When I say party, that means, you need to identify who is settler, who is trustee, who is beneficiary. Everything have to identify. Second thing to do is to monitor the transaction, right? You have to monitor the transaction. Third thing is to do, you have to follow the AML CFT law. These three things the bank has to do. So think of it like this: trust but verify, and verify everyone. Everyone you have to verify, right? So that's why option number B is the correct answer. Now let's look at the next question. Which of the following measure is commonly applied? I think this is a repetition of the question. Let me move to the next question. Yes. Under section 2 WA of the Prevention of Money Laundering Act PMLA, which of the following correctly define a reporting entity? So the question is regarding, PMLA. So PMLA, which of the following correctly define a reporting entity? Options are any individual who conduct financial transaction for personal purpose. Option B, a banking company, financial institution, intermediary, or a person carrying on a designated business or profession. Option C, only bank and insurance company regulated by RBI. Option D, any entity that provide consultancy service without financial involvement. Very good question it is. So what do you think? Out of A, B, C or D, which one? Which correctly define a reporting entity? That is called, RE. This is the question, RE. Right. So let's see the option number A. So option number say any individual doing personal transaction. See, that is wrong, because if you send money to your friend or to buy grocery, you are not a reporting entity. PMLA apply to business. PMLA apply to business, not personal transaction. That's why it is wrong. What about option B? Yes, this is the correct one. This include bank, financial institution, intermediary like a stock broker, right? So some example of intermediary I can give you is a stock broker. And even people running certain business like casinos. Suppose someone is running casinos or real estate. The question is why? Answer is because this sector handle big money and can be misused for laundering. Yes, that is called reporting entity, right? Option number C, only bank and insurance company regulated by RBI. This is wrong. It is much wider. Think of a stock exchange, mutual fund distributor, even jewelers. They all fall under the reporting entity, right? You should know who are the entity called reporting entity. So jewelers, mutual fund distributors, stock exchange, they all are called, regulated entity. What about option D? Any entity that provide consultancy service without financial involvement. So consultancy without financial involvement? No way. If you just give advice and don't handle money, PMLA does not apply. So let me give you one example to make it clear. So imagine that there is a jeweler. Imagine there is a jeweler, and that particular jeweler, he is selling gold. He is selling gold worth rupees 10 lakh. So basically that jeweler is, RE, reporting entity. And he must follow the KYC rule. He must follow the KYC rule. But if you buy a gold ring for 10,000 rupees for your wedding, you are not a reporting entity. Suppose you buy a 10,000 rupees gold for wedding, you are not a reporting entity. So to summarize, we can say, who are reporting entity? Here you can see. Reporting entity includes, first thing, let me highlight, banking company, financial institution, intermediary, person carrying on designated business or profession. These are called reporting entity. Please remember it for the upcoming examination. Short one question will be asked. Right? Please note it down. These are called reporting entity. If you want such kind of PDF for previously held examination, memory based question, you can WhatsApp me on this particular number, or you can see the description section of this video. You will get a link to our AML KYC course, where in addition to such PDF, you get unit-wise theory, unit-wise MCQs covering the entire syllabus of the AML and AML KYC as per the syllabus prescribed by Iibf. Many aspirants have cracked the examination using our material. You can also. So do check our course in the description section. Now, I hope this is clear what is reporting entity. Now let's see the next question. Why do RBI mandate strict confidential regarding the filling of STR? Very good question. What is STR? Suspicious transaction report. That is called STR. Right. So question is, why do bank keep suspicious transaction report a secret? Let's decode it. Options are to ensure customer are informed about investigation promptly, to avoid prejudicing or affecting an investigation by law enforcement agency, to allow customer to correct error in their transaction, to maintain transparency in the banking operation. Right. So option number A, let's start with. Should customer be informed about investigation? Absolutely not. Right. If you tell someone their transaction is suspicious, they might hide evidence or they move money elsewhere. That's why option A is wrong. Option B is the real reason. If a bank discloses STR detail, it can tip off criminal and ruin the investigation. So secrecy protect the process. Right. What about C? Allowing customer to correct error. Sound nice, but STR are about suspicious activity, not simple mistake. So this is wrong. What about D? Transparency is, transparency in banking is good for customer. But if you talk about the suspicious transaction report, it's quite different. Right. So, sharing this information would compromise law enforcement work. So this is also wrong. So let me give you one example to make it crystal clear. So friends, you can think of it like this. Imagine there is a bank, right? This particular bank, it filed an STR. Why? Because it deposited 50 lakh rupees. Because it customer deposited 50 lakh rupees. Right? In cash suddenly. So bank file an STR because customer deposited 50 lakh rupees in cash suddenly. If the bank tells the customer, they might quickly withdraw or hide the money. That's why confidentiality is the key. Right? I hope that is clear. So STR detail must never be disclosed to the customer. Right? Purpose is to prevent the tipping off and protect the investigation. Records should be kept secure, handled by senior staff, and kept separate from the normal data. I hope that makes sense. Now friends, let's see the next question. Which of the following is a key responsibility of head or staff of processing or operating unit at the corporate or nodal office under AML KYC guideline? Right. So a very good question it is. It is talking about the responsibility of the, processing and operating unit at the corporate and nodal office. Very important. Right. Option number A is saying designing, marketing campaign for a new banking product. Option number B, ensuring customer due diligence for various type of customer, taking a special care for high risk. Option C, approving all loan application personally. Option D, handling customer grievance exclusively. So if you look at the option number A, so it is talking about marketing campaign. Do you think that's for marketing team, not the compliance officer? Here we are talking to the context of compliance officer. So AML KYC is about, preventing money laundering, not selling the product. That's why option number A is wrong. Option B, this is the real job. They check customer identity, right? They check the customer identity, first thing. They also check the customer risk level. What is the risk level of customer? They make sure that high risk product or high risk location get extra scrutiny. Plus they flag any suspicious case for investigation. You can see clearly they have mentioned identifying the suspicious case, right? They flag any kind of a suspicious case for, investigation. What about option C? Approving all loan application personally? No, that is wrong. Why? Because that is an operational task, not compliance responsibility. So if you approve all loan application personally, that is operational task. That is what task? That is operational task, right? That is not compliance responsibility. What about option D? It says handling customer grievance exclusively. So we're talking about handling complaint. This is quite important. But that customer service, not AML KYC compliance. So this is wrong. What about C? This is also wrong. So let me give you one example. Let me give you one example to make it more clear. Suppose there is a customer. He want to open an account. Okay. And deposit 50 lakh rupees in cash. There is a customer who want to open an account and deposited 50 lakh rupees in cash. The compliance team ensure that proper KYC, right? The compliance team should ensure proper KYC, right? Check if the customer is high risk. Compliance team will check if the customer is high risk and monitor for any suspicious activity. They don't design, add or approve the loan, right? This is the point. This is how it works. So what we learned? Customer due diligence. This is called CDD. This process is called, CDD, customer due diligence, right? For all the customer. Extra care, high risk product, channels and locations. And they have to detect suspicious transaction for review. So the next time you think compliance is just paperwork, remember, they are the watchdog keeping the system clean. Okay, now let's see the next question. The next question we have is, which of the following is a common indicator of trade-based money laundering in banking operation? So this is called, TBML, trade-based money laundering. So indicators this has been asked. Options are: customer provide complete and clear documentation for all transaction. Option B, inward remittance is immediately withdrawn or transferred from account without business justification. Option C, advance payment strictly follow a standard trade practice. Option D, letter of credit contain a standard clause with no amendment. So if you look at the option number A, it's talking about, complete documentation. That is a normal and good practice. Nothing suspicious here, right? There's nothing suspicious. This is normal and good practice. So this is not a money laundering. So this is not the answer. Option B, yes, this is the correct one. This is a warning sign. Why? Because if money comes in and immediately move out without a clear trade reason, it could mean layering or hiding the fund. It could mean two things. Either you are, see what is happening, suppose this is our system, right? This is our system. Now money is coming in, this is the account, money is going out of the account, right? Immediately moved out without a clear trade reason. There is no trade reason, right? So this clearly indicates, either it means layering or it could indicate hiding the fund, right? So yes, option B is the correct one. What about C? C says, advance payment strictly follow a standard trade practice. That is expected and safe, right? So that is not a money laundering. And letter of credit contain a standard clause with no amendment. So, a standard letter of credit are fine. The problem is when letter of credit are repeated amendment or unusual clauses that raise suspicion. Suppose there is some unusual clause in the letter of credit. Obviously, it will raise suspicion. Let me give you one example to make this crystal clear. What is this TBML all about? So obviously, you can expect a question on TBML in the upcoming examination. So let's make it more clear. Suppose that there is a company. This is a company, right? And this particular company has received 1 crore from abroad. From where? Abroad. From abroad, it has received 1 crore and instantly transfer it to another account. It instantly transfer it to another account without buying or without selling goods. It does not buy without buying and without selling the good, right? So that is not normal trade behavior. It's like, classical TBML indicator. This company, it bought goods, it received 1 crore from abroad, instantly transfer it to another account without buying, without selling the goods. That is not normal trade behavior. It is a classical TBML indicator, right? So this is a classic example of TBML indicator. So let me explain. So account open for advance remittance and close quickly, right? This is a like TBML red flag. We can call it, TBML red flag. Suppose you open an account, right? Open for advance remittance and you can quickly close it. Advance amount not matching trade norms, vague goods description or missing detail in the wire transfer, repeated amendment in LC without reason, and payment against very odd bill or repeated import export of the same item, right? So these are called, red flag. Please note it down. These are called red flag. So let's summarize the key points. What we learned about TBML. Here we can see TBML, using trade transaction to hide the illegal money. That's called TBML. That is the trade-based money laundering. The first T stands for trade. You are using trade transaction. Why you are using trade transaction? To hide the illegal money. Main indicators. What are the main indicators of TBML? Here you can see. First of all, quick withdrawal, immediate withdrawal. This is one indicator. Then we have transfer of inward remittance. This is another indicator. Another sign can be, suspicious document, right? Another sign can be suspicious document or, unusual LC amendment. Unusual LC amendment or, vague good details. These are another amendment. So the next time you see money moving fast than goods, think about TBML. Suppose the next time you see that money is moving fast as compared to goods, you think about TBML, right? TBML means trade but money laundered. That is how you can remember it. Now friends, let's look at the next question. What is the reporting timeline for a CTR under PML rule? CTR, cash transaction report. What is the reporting timeline? Within 7 days of transaction, by the 15th of the next month, quarterly by 30th of the next month, immediately after transaction. So what do you think about, reporting timeline? The question is asking you about reporting timeline for a CTR. So if you look at the option number is 7 days, no, that is wrong. Why? Because, CTR is not immediate, it's monthly. What about option B? Yes, this is the correct one. CTR must be reported to whom? It must be reported to FIU Financial Intelligence Unit India, FIU India. By when? by the 15th of the next month. What about C? It says quarterly by 13th of the next month. This is wrong. Quarterly wrong, because CTR is always monthly. CTR is never quarterly. And what about D? Immediately? No. That is for urgent alert, not CTR. So suppose if a bank see that there is a cash deposit more than there is a cash deposit more than 10 lakh in November. So it must report them by the 15th December. That's it. Suppose if a bank see that cash deposit above 10 lakh in November, it must report them by 15th December. I hope that makes sense. So remember, CTR means it cover cash transaction above 10 lakh. Let me highlight it. All the cash transaction above 10 lakh. That's why it is called CTR. What is the full form? Cash transaction report. So it always deal with cash, or it may be series of connected cash aggregating to 10 lakh or more. Periodicity is monthly. Timeline by the 15th of the following month. Just remember it. Next question is regarding STR. When should an STR be submitted to FIU IND? STR is called suspicious transaction report. Option A monthly, option C within 7 days, option C quarterly, option D at the end of financial year. So what do you think? Option A monthly? No. STR is not monthly. STR is a periodic. Option B is correct. Option B is correct. Right. Let me highlight it. Yes, option B is correct. Why? Because as soon as you identify suspicion, report it within 7 days. Right. What about C and D? No. That's too late. Suppose a bank find a customer moving fund strangely. Right. Suppose a bank find that a customer is moving fund strangely. Right, today. So it must report within 7 days. It will not wait for, no waiting for month end. So remember, STR apply to any suspicious transaction. Either it can be cash or it can be non-cash. While CTR only apply for cash. Right. Timeline is within 7 days. That's it. Just remember it. Right. Now, next question. CCR. Which transaction require a counterfeit currency report and what is its reporting timeline? Option A, all foreign currency transaction reported immediately. All cash transaction involving counterfeit note reported monthly. All suspicious transaction reported quarterly. All high value transaction reported annually. So this question pertains to CCR. That's called counterfeit currency report. That is called CCR. So friends, which option do you think is correct? So let's look at each and every option. Option A say foreign currency, but it is wrong. It is wrong. Option A is wrong. Why? Because CCR is about fake notes. Remember, it does not include foreign currency. If I say CCR, just remember it. Let me erase it. Yes. So if I say CCR, you must remember it. This is about fake currency or fake notes. Just remember it. What about option B? Option B is correct. Why? Because if counterfeit note are detected, report monthly by 15th of the next month. Right. If you detect any counterfeit note or forgery, report it by 15th of the next month. So friends, just remember this: CCR and CTR, they follow the calendar. They follow the calendar. What about STR? So STR, they need speed. That means weekly, and they are monthly. This way you can remember it. Now let's have the next question. Which of the following is a key responsibility of the head and staff of business or product unit under AML CFT guideline? Yes, very good question. They are talking about business and product unit. Option A, approving all customer transaction personally. Option B, including AML CFT aspect in product paper and SOP and identifying high risk business line. Option C, handling customer grievance exclusively. Option D, designing market campaign for new banking product. Right. So this is the question. They are talking about head and staff of the business or product unit. What about option A, approving all customer transaction? So it is impossible. This is not their job, right? What about B? Yes, they make sure that AML and CFT rules are being built into product paper and SOP, standing operation procedure, and standard operating procedure, and identify high risk area for extra monitoring. Yes, that is their role. That is the role of the head and staff of the business or product unit. What about C? Grievance, right? No. That's customer service, right? Not compliance. Here we are talking about compliance. That's customer service. What about option D? Marketing campaign. So that is for marketing team, not compliance officer. So for example, suppose you are launching a new product like a prepaid card. Suppose you are launching a new product like a prepaid card, right? So the business unit, they must include AML check. Business unit must include the AML check in the SOP and flag if the product is high risk. You should flag. They should flag when they should flag when the product is at high risk, they should flag it, right? So remember the key points: embed AML CFT in the product design and SOP, identify high risk business line and customer groups, right? So these are the two things. So I hope it is clear. Now let's look at the next question. Which of the following tasks fall under the role of head and staff of the processing? See, just now we are talking about head and staff of the business processing unit, right? Business or processing or operating unit. So which of the following tasks falls under the role of head and staff of the processing and operating unit at the corporate or nodal office? Option A, conduct media research. Option B, customer due diligence for various customer type. Option C, drafting AML CFT clauses for product paper. Option D, approving marketing budget. So what about A, media research? That is for investigation team, not the operation. Here we are talking about the operating unit. You can see written here, right? What about CDD? Yes, this is the correct one. You know, they handle KYC. They apply extra check. They apply extra check for high risk customer, and they flag any kind of suspicious transaction is there. They flag it. So three things they do: KYC check, extra check for your high risk customer, and flag any suspicious transaction. That's why B is correct. What about C? C says, you know, drafting AML CFT clauses for product paper. So that is for, you know, product unit. Just now I have told you in the previous question. So previous question was about you know, product unit. Here we are talking about the operating unit. Understand the difference, right? Product unit, they draft AML CFT clauses. But if you talk about the operating unit, they don't draft it. Rather, what they do, they handle KYC, right? What about option D? Approving the marketing budget. That is totally unrelated. Let me give you one example. Suppose there is a customer, right? He want to open an account. And suppose there is a customer, he want to open an account and he deposited 50 lakh in cash. So what operation staff will do? They must verify the identity, apply enhanced check and escalate if it is suspicious. That is called, you know, customer due diligence. It is done for all the customer. Extra care for high risk products, channels and location. So let me just summarize two things we have just discussed. So business unit, right? Business unit, they build AML. Remember, they build AML into product. They build AML into product. And operating unit, they apply AML on the customer. Please understand the difference. These things are very, very important. This has been taken from your Macmillan book. And this thing will not be written in your book. This is the way to remember. Business unit means they build AML into product. And operating unit means they apply AML on the customer. They apply AML on the customer. I have given you two examples to make it clear. So think of it like this way. Business unit design the rule, operating unit enforce them, right? Who designed the rule? Business unit. Who enforce them? Operating unit. This way you can remember the function of business unit and operating unit. I hope that makes sense. Now friends, let's see the next question. So if you really think that this video is helping you, giving value to your preparation, please hit that like button. Question is, can foreign student open any bank account in India? Let's have a look. Which of the following correctly describe the requirement and restriction for opening of account for foreign student coming to India? Option A, foreign student can open a resident saving account with no restriction. Option B, they can open an NRO account by providing passport with visa, photograph and admission letter. They open any account type without address verification. They can open an NRO account without any transaction limit during the first 30 days. So if you look at the option number A, it's talking about, you know, resident saving account. Do you think they can? No way. Foreign students are non-resident. So they can't open a resident account. So option A is wrong. What about B? B says they open a non-resident NRO account by providing passport with visa, photograph, admission letter, local address must be declared within 30 days, and pending verification. Inward remittance is limited to $1,000 and monthly withdrawal to $50,000. Yes, correct. They need to provide this passport with visa, photo, admission letter. They must declare their local address within 30 days. 30 days, right? And inward remittance is capped at $1,000, right? That is the inward remittance, and monthly withdrawal at 50,000 rupees. Yes, this is the correct one. What about C? They can open any account type. No address verification. You know, resident without address verification. That is against the KYC norm. Every account need proper address proof. What about D? They can open an NRO account without any transaction limit. No transaction limit? No. Actually wrong. Limit apply until address verification is complete. Because they have to, local address must be declared within 30 days. Till then, inward remittance is capped to $1,000 and monthly withdrawal to 50,000. So imagine, let me give you one example. Imagine that there is a student from US and he comes to India, right? Suppose there is a student from US, he comes to India for studies, right? So what he will do, you know, they will open an ADO account, right, with passport, visa, and admission letter. Passport, visa, and admission letter you take and open an ADO account. Okay, for the first 30 days, they can only receive up to how much? $1,000, and they can withdraw how much? 50,000 rupees until their local address is verified. Once their local address is verified, then this cap is removed. Then this cap is removed. Just remember it, right?